Hi, I'm Imre and I'm joined today by Professor Andreas Park. This is a follow-up discussion to Professor Park's pre-recorded webinar on cryptocurrency. We're going to be taking a bit more of a deeper dive into some of the questions that have been submitted to us. So Professor Park, let's get right into it. One thing that we discussed the other day was AML concerns around cryptocurrency and other illegal activity. And something, it's something really interesting happened just the other day regarding this. Perhaps you'd like to expand on that a little bit further.
Absolutely, Imre. And it's nice talking to you again. So for those of you who have missed it, the FBI announced, I think it was either today or yesterday, that they have managed to seize a Bitcoin wallet of a group of hackers that threatened the US infrastructure with a ransomware attack. So for those of you who don't know, ransomware attack basically means you hijack a computer and you only release the computer after you pay the ransom. And these ransoms are increasingly paid in Bitcoins these days. Now, what the FBI has managed to do is they traced the transactions as they went around. They found the wallet where the money was kept, and then they managed to hack the wallet and extract the money. Now, for that, I want to just be, because there's a tiny inaccuracy in how I described it actually, because technically the wallet itself does not contain the money. But a wallet is for those of you who don't know, it's either an app on your phone or it's an app on your desktop, usually linked to your browser. And what that is really is a piece of software which keeps the keys to your bitcoins as they are, because the bitcoins are actually stored under a particular identifier on the blockchain. So they're actually on the decentralized network. They're not kept in the wallet. Now, functionally means the same. Once you hack the wallet and you have access to the key, you have control over the bitcoins or other cryptocurrencies that live on a blockchain. And what I found really interesting about this is two things. Number one, the high level of transparency that the Bitcoin network and most blockchains afford allowed the FBI to actually trace where the money went. So they could still continue to follow the money. They didn't need a bank to be doing that for them. And secondly, they also now had a way to hack into that wallet and actually extract the money again. So what I'm trying to say with this, and what makes this interesting is, these new technologies give law enforcement also a totally different set of opportunities to catch criminals, to follow criminals, and to see where they're going with it. And I think that's actually quite interesting all by itself. So yeah, maybe I should just leave it at that for now.
Well, this leads really nicely into another question that we've received, and it's would you be able to speak a little bit to the security concerns around cryptocurrency holdings? There have been some well-publicized events of hacking, as you've just mentioned, and also people's investments entirely seemingly disappearing or being rendered inaccessible.
Yes, so there are a number of really interesting questions surrounding this. So as a first step, when we're talking about the blockchain proper, the way you access it is with a wallet. A wallet is just a piece of software which keeps your private keys. So and I'm going to be a little bit more detailed here so that everybody understands how this normally works. So holdings of a digital token are attributed to a public address on a blockchain, right? So this is in Ethereum, it's something that usually starts with 0x. You can think about this as an account number. Now, you shouldn't think about it as an account number from a Canadian perspective, which you never want to give out. You should think about it from a European perspective, where people put account numbers on letterheads so that you can send them money. So this is public. Everybody can see it. Having access to this means you have no ability. It means nothing. It's totally safe to share it with other people. However, what you need to use if you want to transfer the money or control it, you need a private key. So that is essentially, think about it like a key that you have to a safety deposit box. And if you want to make a transfer, you have to use this private key to sign a transaction. Now, showing somebody the signature that you have for signing a transaction is totally risk-free, right? So it's not possible to extract the private keys from the signature. And this is basically how transfers or any transaction on blockchain would work. But the key part is that the piece of this private key that is kept in your wallet. Now, the problem is the wallet itself is on your computer or on your phone, and it is saved simply by a password. So if somebody has the ability to hack your specific wallet, then they have control over your digital items. I mean, that's a simple fact, right? So if there's a vulnerability in the software that that the wallet has, you're out of your money, and it's no longer possible to recover it once somebody has stolen it from you. And these wallets, they're sometimes referred to as hot wallets, they can be hacked. Now, it is not like the hack that happened for say the credit rating agency in the US. Was it Equifax, or what's it called, right? Where essentially once you open the door to the barn, you can see all kinds of keys from anybody. So it's not like there's a company that stores your keys. It's all in this wallet. So if somebody wants to hack you, it has to be done on a case-by-case basis. And it's not that straightforward to do, but there could be vulnerabilities. And for instance, for this FBI case, there must have been a vulnerability. Fair enough. There's other ways to store your wallets, to store your private keys. There's something called hardware wallets. And if the hackers had used one of those, it would be much harder for the FBI to hack it. But here we are. So that's the first thing. Now, there's an entire industry that develops around the idea of having to store the private keys for you. There are actually safer routes to manage private keys than just having them in all in one wallet. There's something like multi-signature wallets where you need multiple different pieces of information to sign off a transaction. So it's much harder to take control of your holdings. So sorry, I'm going on a lot of different pieces here, but there's one more thing that I really want to talk about, which goes back to law and regulation. Imre, hopefully you bear with me for a little bit. And that is the question of exchanges. Now, for those of you who follow this a little bit, you may have seen that the OSC or the CSA, the Canadian Security Authorities, sent a letter to about, 50, 100 or so crypto exchanges in the world and said to them, you have, you provide services to Canadian customers. So therefore, you have to abide by Canadian regulation. You're subject. We believe you're subject to our regulation, and you have to register with us, and so you have obligations for the safekeeping of Canadians' assets. Now, why is this relevant? When you use these crypto exchanges, they're called centralized exchanges. Effectively, these exchanges take custody of your assets. And that means that if there's, for instance, a hack on the exchange, that your assets are not safe, number one. Number two, as we know from the case of Quadriga X, which is a Canadian crypto exchange out of Vancouver, the person who is the owner of the exchange suddenly died, allegedly. I think there's still some uncertainty of whether or not he's actually dead. And took with him the private keys to the wallets of the exchange, which meant that nobody could access them any longer. Now, why was that a concern? So there was many concerns around that. But effectively the case here was that essentially people lost access to their funds, which were in the custody of Quadriga X. And that was the end of it. Now, the story is a little bit more intriguing, but if, I'm just going to stop here now because I gave a really long answer already to a short question.
Yeah, I wouldn't be surprised if there was a Hollywood movie made about what happened with Quadriga in the future.
For sure, with cotton, yeah. So just to pat myself on the shoulder for a little bit, I wrote a column in the Toronto Star in 2017 where I said these crypto exchanges are incredibly insecure. We don't know what they're doing. Your assets are under the custody of somebody else. And worst of all, you don't even know if what they're selling you on the exchange is something that they actually have. So I think this was actually one of the major problems with Quadriga X, that the exchange itself would sell you Bitcoin, and they didn't have that Bitcoin. So had all the users, and so the reason why they did this is because they thought, well, nobody is actually using all the and extracting all the and putting all their holdings onto the blockchain. They're actually keeping them on the exchange. You have some exchanges that give people leverage of about 100 to 1 for trading in cryptocurrencies. So use $1 and you can buy $100 worth of Bitcoin. That is crazy, let's say, for most people, right? Because the handling leverage is pretty difficult, and understanding the risks is not straightforward. And of course, the exchanges will not have the Bitcoin holdings to, if you want to liquidate your position and take it out, to do that. So there's a lot of concerns, and there's a large set of regulations that are in place in the normal world to protect people and to protect their holdings. So I am fully in favor of regulating these centralized exchanges.
I'm very glad you brought up that point, because I'm in complete agreement with you. The best parallel that I can draw here is when foreign exchange trading became incredibly popular. You saw FX brokerages offering clients leverage. To get leverage of 500 to 1 or 1,000 to 1 even was not unusual. Now, obviously, there's a question. The question is to balance what people want. Obviously, higher leverage means a lower barrier of entry to trading. On the other hand, however, there's also the question of protecting your retail investors and traders. As the FX industry became increasingly regulated, we saw rollbacks on the amount of leverage that could legally be offered by brokers. So, for example, in North America, 50 to 1 is the maximum, and obviously, that's a big step forwards from 500 to 1 or 1,000 to 1. And I think it's as regulation increases, we will see more and more credibility be established around a few of these centralized exchanges. And my hope is that in the future there will be more options for your average person to onboard with an exchange, go through their KYC, their AML procedures, and feel safe in doing so. So I completely agree with you. I believe regulation is an incredibly important step to take here for consumers.
Absolutely. Well, and it particularly applies to situations where, you have custody of other people's assets, or where you push a product on them, where the other side may not fully understand what they're getting themselves into. Now, I have a different view on situations where nobody pushes anything on you, but that's a different question, right? So so let's put it like this, right? So this much of my talk was focused on decentralized finance, and decentralized finance is essentially has the idea of, here's a product, we deploy it as a contract on the blockchain. Here's what it does, and nobody forces you to do it. Nobody, in many cases, nobody actually directly benefits off of your doings on that one, and so it's not like somebody can dupe you into using it. And I think there's a very fundamental difference. It's a little bit like, I know that there's still a functional difference, but if you think of open source code, right? So you deploy open source code. I think the license that one uses, I think it's called an Apache license, but I'm not a lawyer, so I'm not 100% sure. But it basically says that you want to use this piece of code, go ahead, do it, but it's at your own risk to do so, right? In some sense, this is how the decentralized finance world works. So, now there's different interpretations in different jurisdictions about even what open source code means and what the responsibility of the other side is. And there's another part which is different, is that in some sense, like Uniswap, there is still some fees that go to some particular party, which is involved in this. So one has to be a little more cautious about it. But this is essentially when we're thinking about having a balanced regulatory approach and thinking this through. I think this is where it gets interesting and also hard. Regulating the centralized exchanges, which are essentially businesses that often run like a brokerage, I have no problem with that.
All right, let's change gears a little bit, moving towards the use cases for cryptocurrency and the blockchain in general. What other uses do you see here besides simply transferring cryptocurrency or being able to hold it?
Well, so the big question, so first of all, the native application for a blockchain, which is essentially a resource or value transfer infrastructure, is anything relating to finance, right? So that goes without saying. So financial contracts of any kind, derivatives, loans, funds, and all of this can be run on that kind of infrastructure. That's really what it's made for, if you want. So, for instance, in the future, and we're already seeing some of this, but in the future, I'm sure we're going to see the tokenization of real world assets, of stocks, bonds, options, and so on and so forth, which will be run on a blockchain. It's already happening. Binance, for instance, has listed Tesla stock as a token. There's actually some decentralized financed entities that already run this. So the whole idea of the blockchain world is to tokenize everything. Anything that can be tokenized, you will see in some form tokenized. And let's face it, we have this in the traditional world of finance too. You can trade essentially any Canadian stock in the US in the form of an ADR, an American Depository Receipt. Funnily enough, that actually means that in some sense, Canadian companies that operate in Canada, have never listed in Canada, never sought a listing in Canada, are still somewhat subject to US regulation. US regulators impose themselves on Canadian companies that way. It's a complicated problem. I have a colleague who's now used to be at York, and she's now in Melbourne Business School. She actually has a string of papers on that one. It's a quite crazy world. But then once we step away from the world of finance, there's other things that you can do. You can tokenize other things. You can, for instance, tokenize identity. Once the blockchain has high capacity and high working, you can, so it has the ability to scale. You can store any piece of information that has to be secured and immutable and censorship resistant. You can put on a blockchain. Identity portions could be one of them in some form. So digital identity is certainly something that people work on using blockchain tech. I'm a little cautious with this, but you can also think of votes and voting generally that can be run over a blockchain. Now, for that, you need to have additional functionality. You need something called zero knowledge applications. Now, what those are essentially is to anonymize some interactions. Now, this is where it gets tricky, when I say before blockchain is very transparent and so on and so forth. When you have zero knowledge applications running, that essentially leads you to the ability to do something totally anonymously. It's a little complex to explain. I don't want to do this now in this Q&A. But the basic principle is one where, you can hide. So you prove that you are the owner of something without showing the person who checks that you're the owner of something what it is that you actually own, if that makes any sense. I could spend a few minutes to try to explain this. What do you think, Imre? Should I, or is this too complex? Maybe I should.
I would say go ahead, because I personally think this is an incredibly important application, and it has far-reaching implications for other sectors of finance as well, not just cryptocurrency.
That's right. So let me first give you an example for how this would work with identity and where this would matter. So imagine, so I have my daughters. I have two children. They're daughters. Eventually, they'll probably want to go clubbing, right? Now, when you go clubbing, you need to show your ID that you're of the right age that you can go. Now, if you go to the bouncer at the door, you don't want to show them your ID. Why? Well, because in principle, you don't want to show them your ID because they see your name, your address, your age, lots of information that they don't need to see. All that they need to see is that you're over 18, let's say, so that you can enter the club, right? That's the only piece of information you need. And so you could use blockchain technology to provide that kind of information to the other party. And you say, here I am, and I can prove to you that I am over 18. Now, the example that people usually have to prove that you have something without showing it what you have. So in this case, you prove that you're over 18 without showing the ID, works as follows. Imagine there's a cave, right? And in this cave, this is a circular cave. And at the other end of this cave, there is a door. Now this door is locked, right? So you want to prove, when you go into the cave, you can go to the left or to the right. If you have the key and you go to the left, you can walk all the way around because you have the key to the door, and you come out on the other side, you come out the right exit, right? Now you want to be able to prove that you have the key to the door. Now imagine that the person who is the prover cannot go into the cave to see you come out on either end all the time, right? So what you have to do is you basically have to go into the cave, and you have to prove that you can come out on the other end without showing you that you had the key, right? And so you basically, this is kind of the process that you have in order to prove that you are the owner of the key without showing somebody the key. Does that make sense?
Yes, that makes a lot of sense. And on a to me, on a personal note, the other implications for this are in things I'm dealing with currently, which involve very complex transactions with multiple parties, which requires proof of funds, proof of title for certain products and so on. And right now, currently, the solutions to these kinds of situations are not particularly elegant. And it can be frustrating at times. And so this is, in my opinion, an application that I hope takes on fairly quickly, because it can help resolve a lot of complex transactional issues.
Yeah, absolutely. I agree. There's a lot of simplification that can come in that sphere. And if I can maybe say so, for instance, also for votes on blockchains, if you actually want to do some form of voting, that would work actually quite well when you can show proof identity without actually revealing who you are, and so that you can submit your vote on a particular topic. Now, this doesn't solve all the problems that the US has with its own voting, because they have identity as a whole is a problem over there. But it could lead, for instance, in countries that where there is always a threat of tampering with ballots and so on and so forth. This could potentially be a solution. Clearly, for an autocrat who wants to keep a hold of a country, this is not good news, and I'm sure they will not be so keen to implement it. But this could be a solution going forward.
Absolutely, I agree. Okay, this next question is it's a big one, and I have my own strong thoughts on this. So I'm reading the question directly here, word for word, and I quote: "When markets are being so clearly manipulated by people like Elon Musk slash big finance, how can cryptos gain mainstream acceptance?"
Yeah, so that's a really good question. Now, with Elon Musk, it's a difficult question to say if he's actually really trying to manipulate or if he's just blabbering around, because he is a bit of that type of person. He when it comes to Tesla itself, he makes grandiose claims, and he basically should have probably thought a few more times before making some of the statements that he did. So we don't want to. I don't want to call him particularly a manipulator, but the mere fact, and this is where the question goes the right way, the fact that Elon Musk will say that, oh, we're not going to do Bitcoin anymore because it's dirty, and that sends the Bitcoin price down by $10,000 per Bitcoin. That's disconcerting. The fact that there is very clearly the possibility of market manipulation is a real problem. Now, this brings me back to my personal mantra, which is I do not like to think of the crypto world and of the blockchain world as an investment class, right? Or as a new asset class. I know that there is part of that is true, right? But I think it would be much more helpful if people would actually think about it and think about this world more about a new financial infrastructure and what it could do once it comes to full deployment, right? So ultimately, the manipulation from prices comes from the fact that there are lots of shady channels so that you can trade these cryptocurrencies. There are shady exchanges, and that there are shady businesses around it. So one of the most common manipulation, or not common manipulation, alleged manipulation, comes from Tether. Now, for those of you who don't know, Tether issues a token which is the digital representation of a dollar. They were essentially, I think, one of the first companies that actually made this happen. And what a Tether therefore is, or as a USDT is sometimes referred to, is the argument is they issue this token, and for each of these, that's at least what they said early on, they have $1 in a bank account. Right now, by now, there's several billion of those floating around. I think Tether alone is about $60 billion worth of Tether is floating around in the blockchain world. And they claim that they have assets, high quality assets to back them up. However, Tether has never been subjected itself to any kind of audit. They avoid it like the pest. The New York state attorney or attorney general has tried to prosecute them. And so in the context of that, they had to reveal some information, but it is entirely unclear what they actually had. Now, there's some academic research, though, which basically shows that every time Tether made a major issue, the price of Bitcoin was going up dramatically. So what most likely, so the allegation is what happened is that actually Tether issued the coins, bought Bitcoin, pumped up the price, and they didn't actually have the US dollars to back it up. I think that's a concern, right?
That's very dangerous. That's it has the potential to be exceptionally dangerous.
Yeah, absolutely. I mean, this is essentially, it's the craziest thing ever, right? You basically buy something with thin air and you make something that is thin air into thin air. This is just not right. So, and then the fact, obviously, that can only work also with the blessing of an exchange to be doing that, right? And so this is why, again, these centralized exchanges matter. Doing the same thing on the blockchain and in a decentralized finance world is much harder, I would argue, right? So when you have these connections, these interfaces of the real world with the blockchain world, I think there has to be some level of control to maintain that there is credibility of what's going on. Now, next thing is the crypto exchanges that, and I think, as you can see here, the crypto exchanges play always a major role. Same with the manipulation. The manipulation of prices happens on crypto exchanges, mostly, I would argue. So, this is why the crypto exchanges play an important role. But if you think of Coinbase sought to be actively regulated. They try to comply. Binance is in Singapore. They are working together with the Singaporean authorities. Now, of course, Singapore has a different set of rules than the US, but still, so Binance, for instance, is hopefully, that's at least my impression, they're quite careful with the listings that they put on there, right? So whatever tokens can be traded, they put some level of scrutiny on those tokens. I hope that's what they do. And at least that's something, that gives, the whole system a little sort of level of comfort with what is happening. That being said, not all crypto venues do the same, right? So manipulations of prices happen. As I said, but let's just go back, Imre, if you allow me to. So I want to go back to my mantra and say, look, this is really about a financial infrastructure. It's not about, gambling with tokens. This is really important to understand. And it's really important to understand why, right? There's billions of people in the world that don't have access to financial services. And through the blockchain, a very large number of people that have cell phones, for instance, would have access to this infrastructure. And that will be a good thing because, the literature on development economics is really clear that when people have access to just the most basic forms of financial services, that leads to their betterment. And, the financial sector has done nothing about that so far to do anything. I mean, you can't blame, of course, Canadian banks not wanting to do something in Liberia, but this is an opportunity. It's a huge opportunity. And in the US, 20 or 30% of people are considered to be underbanked. That means they don't have proper access to financial services. These guys have to go to loan sharks. They have to go to stores that issue that cash the checks at huge fees because the financial sector just doesn't value their business. If you have an alternative infrastructure that would allow them to have access to basic financial services, I would argue that's a good thing, unambiguously.
It's I call it the democratization of financial opportunity. And going back to your comment about a large percentage of people, even in the Western world, being underbanked. You see, one of the things a lot of people don't realize with the banking system, and this is a little bit academic, but it's still a reality, and it's a point worth making. If you ask most people, if you deposit $1,000 into the bank, how much money do you think you actually have in the bank? People will say $1,000. Now, yes, that makes a lot of sense, but the reality is that you don't, because the bank is going to use that money, and theoretically, they should have enough as far as loan loss provisions go, and their insurance goes to cover your initial deposit. But the reality is that once you put in that $1,000, it's no longer there. It's going to be used by the bank. Now, for most of us, that is a theoretical concern, right? I would never expect RBC to not be able to make good on my withdrawal request for $1,000. But it does, in my opinion, raise the larger question of, what kind of relationship do we currently enjoy with our financial institutions, and where does the balance of power lie? And I think that's where something like the blockchain is so powerful. It's so powerful because it opens doors to opportunities and to a whole new world of financial services that I think a large percentage of people will probably leap at once the infrastructure matures.
Yeah, absolutely. I mean, okay, so there's many things that you said, and there are many aspects to consider, right? So, for instance, a customer is not cheap for a bank to have, right? So once you have an account, once you open an account for them, you have to do their KYC, you know where they are. You have to maintain the relationship. There's a possibility that once you give them a debit card, that they overspend and you're out of money. That and you may have some losses because of that. All of that is a possibility, and this is something why banks try to shy away from people who are low income or who live in communities that that are considered to be less reliable on some form. um, I mean, so we're in Canada, right? So think about the indigenous population. How many banks are actually have branches uh, in the areas in the northern communities of Ontario or in the or in the rest of Canada where mostly the indigenous population lives, right? And so then the question is, do they actually have access to the financial system such as it is? And therefore, do they have access to the ability to save and to better themselves? I think the answer is often no. And now, obviously, I don't want to accuse the banks of not providing a particular service. I think it's quite difficult to provide. But the reality is, with a cell phone in your hand, with access to a cell network, at least you have the ability to use a blockchain of some form, right? Which I think again is a good thing. Same holds for many countries in Asia, right? In Indonesia, they built cell towers in the jungle, right, where there was nothing. And imagine the population that lives there eventually will have access to smartphones because smartphones are not that expensive. And with that, they can have access to financial services again. The extent to which mobile money in Africa led to a betterment of financial transactions. The ability just to keep your money safe by not it being able to be stolen at gunpoint easily. That is huge, right? And I mean that has nothing to do with blockchain per se. It has to still do with a technological innovation, but blockchain just goes in the same direction.
And how do you see that changing now that many countries have signaled some kind of interest in terms of becoming directly involved in this space?
It's a good question, actually. So I tried to allude to that at some point in my talk when I talked about CBDCs, right? So central bank digital currencies. And for many countries, it's a trade-off, right? If you think of Argentina, they used the US dollar as a parallel universe currency for a while, and then they had to limit the ability from people to extract US dollars in cash from their bank accounts, and so on and so forth. In a blockchain, that would be less of a problem, because once your money is on the blockchain, it's really just a market that we're talking about. And it's not so much a question of how much US dollars your banks can provide. So in that sense, it's a good thing. Many countries are almost plagued by the unreliability of their central banks and themselves of printing money to pay their bills. So again, that could be using some other country's currency could be a bonus. I mean, I'm not sure if you remember the story when Iceland was considering adopting the Canadian dollar, right? With a digital representation on a blockchain, they could do this overnight. They don't even have to ask anybody's permission, right? You don't need to schlep over the cash to use, right? So this gives a lot of different possibilities. And let's face it, in the world, there's only a very small number of currencies that can actually be generally considered as stable, right? So they are stable because they peg themselves to the euro or the US dollar or the yen or sterling or the like, or they're just paper. That's it. You need to trust the government with that, and that's not always often warranted. So there's lots of new opportunities that arise from this development. But we'll see where this goes. It's not straightforward, and there's a lot of kinks to iron out. I want to be very clear about this, right? So I would not think that any responsible country at this point would put its entire currency to run on the Ethereum blockchain. It's just technologically not possible, and it's also not responsible to do.
Yes, I would agree. It's going to take time for this to play out. But what a ride it has been so far, and it's crazy to think of the permutations and the evolution of the blockchain and cryptocurrency as a whole as we move forwards. And going back to something you said earlier, and it's a point I wholly agree with, when the interest in this space moves from speculation, or mostly speculation, to really considering the infrastructure, I think that will bring a significant shift in mindset, and I'm assuming that that will help accelerate the progress, and also see some refinements in the involvement of countries like Canada, for example, in the blockchain space as well.
Yeah, I agree. I think there's huge benefits that could be in certain market interactions. So I'm in one of my examples is also the OTC market for, say, corporate bonds, right? It's a very illiquid market. It's a market which is extremely fragmented because it's basically run by dealers. And none of them can be blamed for what they're doing. They provide an important service. Intermediation is a risky business. It's expensive to do. And so and you've worked for not centuries but decades to build up that business. But you could argue that some of the trading facilities that are currently being developed on the blockchain could be much more beneficial, right? So you can imagine that you put things such as these, so that you have dealers pool in something like a swap exchange, right? And that would be providing more liquidity to the market, would make transactions cheaper, and that would ultimately mean that the firms that issue these securities have lower financing costs. I would argue that's a good thing to do. But I want to be clear, right? So it's not like everything is ready and we can switch from one day to the next. There's a lot of problems that have to be solved. This is still experimental, but these experiments that are run, I think, are quite powerful, and they show actually what is possible. So I think from that perspective, I think we should cheer on this development.
So what do you believe the future holds? What's going to be different in the next 5 years, 10 years from where things stand today?
That's a really good question because there's so many moving parts, right? So let's start with the blockchains world as a whole. My guess is that the Ethereum network will eventually merge not eventually, by the end of the year, that should probably merge the proof of stake and the proof of work protocol, which means that proof of work is no longer necessary. So the environmental concern, at least for the major blockchain, goes away, right? Now, they still need to solve some of the scaling problems, like they wanted to do sharding. I mentioned in my presentation that my colleague Fan Long has developed this idea for Conflux, where you have parallel processing of blocks. If you add the two together, you would have a tremendous ability to tremendous gating power already available, right? So Vitalik Buterin, for instance, that once you have sharding available, sharding would allow transactions rates of, he said, 300,000 transactions per second. If you do this on this parallel processing scheme, in addition to sharding, then you may actually looking at something on the order of 7 million transactions per second that are possible in principle in the blockchain. So then you can run a gazillion different things on the blockchain. So just to give everybody an idea, when I talked about zero knowledge proofs, right? So the idea of proving that you own something without showing what it is that you own. When you have a normal transaction, we take one cryptocurrency token like Ethereum and transfer to another address, that takes 21,000 computational cycles. This is what they measure. It's a gas, right? So this is the measure that they use for that. Doing the same thing with a zero knowledge transaction is roughly 1.7 million transactional cycles. So it's many orders of magnitude more that you need for that. And it's not feasible to do this in a current blockchain. But when you have the ability, when you have these enormous scaling factors available to you, then you can actually do these things, right? You can, do it effectively. This does not solve all the problems either, because there's the issue of data storage that becomes a problem eventually. So that has to be solved in some form. So I'm just saying that these are all technological problems, and I hope that they will be solved within the next 5 years, right? So I don't think they're going to be solved by the end of the year, and not within 2 years, but eventually. So there will be that part of the ecosystem will develop. There's no question about it. There is a lot of demand and interest from a lot of different areas. Every Toronto high school has a blockchain club. So if you're 40 or 35 and you think this is not going to happen, I'm sorry, I think you're wrong. The young generation will come out and they will do it, right? So never underestimate that. Just because you're an experienced financial services professional in your 40s and 50s and you think regulators are going to come and how do you do anti-money laundering? Meh, somebody finds a way around that. So that's that part. The next thing is the DM network, which is coming from Facebook. I imagine it will, I'm pretty sure it will go public. It will be a completely different model of a blockchain, but it's actually going to be extremely powerful because it will bring fiat currencies of the US dollar, the euro, the yen, and the sterling to an enormously large audience. And you will all of a sudden see that people in countries like Nigeria and other countries in Africa, people in South America and Peru, Ecuador, and other places that currently are excluded from the financial sector will all of a sudden have access to it just by virtue of having a cell phone. So that's going to be huge. And of course, then you have the governments. The governments will eventually move on their CBDCs, which is going to be extremely interesting on many different levels. So first of all, it affects the way how banks operate, right? So it goes probably beyond what I want to discuss here now, but once people have CBDC wallets, there's a question of what happens with the deposits, what happens with fractional banking. This is actually a problem. One has to think that really carefully through and how you want to react to this, even as a central bank. It also is a question of how these CBDCs will be interoperable internationally, right? So when the US does one, China has one, do they actually talk to one another? The cool thing about blockchains is, so for instance, my colleague from Fanlong, I'm coming back to him, but he does some really cool stuff. They have developed a tool which is called Shuttle Flow, where you can basically shift assets between different blockchains, right? And this is actually quite phenomenal because it's decentralized, trustless, and so on and so forth, and yet you can use things on different blockchains. Pretty cool. There will be a bridge built to DM, and then there will be bridges built to CBDCs. So there's going to be a very, very fundamental changes that we see in the financial sector coming from this. And if you're a bank and you're not already not just thinking about it or having a 5-people team working on it to just keep a track of it, if you don't commit by the end of the year a 30 to 50 people team that builds the services that you will offer on a decentralized blockchain, on DM, and on a CBDC system, I'm sorry, your lifetime is very limited.
I completely agree. It's when you lay it out like that, it's truly amazing the scope of how much more work is yet to be done, and that leads very nicely into our final question today, which is what would you tell our young alumni or even current university students? What would you tell them if they wanted to get involved in this industry, in this space, and to work in it in one way or another? That's a big question, I know. There's so many different spaces.
So let me put it differently a little bit. So let me not quite answer that question because giving particular advice is hard. Let me just tell you what the reaction of students is when I teach the class, right? And I can tell you the reaction from students is extreme optimism and enthusiasm for it, right? And the reason is quite simple because I teach commerce, and so the students are already in a business type of mindset, so they want to work for business. That's not necessarily the case for people who work in engineering, computer science. They're often more independent and free spirits, right? But think about just the most streamlined students that you can have come from commerce, and they get really excited about this because in some sense many of them, they want to have the security and the income that a banking job can get them, but they kind of don't look forward to being just part of a big machine. So I'm sorry to say this, and I hope nobody takes offense with this, but if you're in your early 20s, you don't picture yourself being the kind of person that increases the fees on a single mom's bank account so that she all of a sudden can't feed their kids anymore. That's not how you want to live your life. But that's the reality of what actually bankers have to do at times. And so when you tell these guys, hey, you can do this new thing and you can develop new tools and new applications, they come up with really great ideas for how they could have an impact, who they can provide service to, who's underserved, who, you know, and the crazy thing about some of these blockchain things is that you can think about providing a service at relatively low cost, and you can really target it to people that would really benefit of this, and they have no other option to it. So for many students, this is exciting, right? So if you have to, if all that you have to do is write, you know, 500 lines of clever code to provide a new service, and you can really help people with that, I mean, I don't think it gets any better than that. So what I'm trying to therefore encourage my students to do is to walk through the world with open eyes and try to look for opportunities, try to see where they can have a positive impact in their environment, and actually help for the betterment. And you know, being part of a big machine and working for a bank, there's nothing wrong with this. And so don't get me wrong on that one. People do, even in normal traditional financial institutions, people do a lot of good for people and they help them. But you know, there's other opportunities that arise, and you know, for young people in particular, that can be quite exciting. So
Thank you for that approach to answering that question. Those are all the questions that we have for today. Thank you very much for joining me again, Professor Park. It was an excellent conversation, and we had some pretty tough questions to answer, ranging in scope, from everything from regulation to the future of blockchain and cryptocurrency. You did such a fantastic job getting through those tough questions. So thank you very much. And once again, I enjoyed our time together a lot.
it was my pleasure. Thank you so much, Imre.